And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show, presented by RIA Advisors.
And good morning. Welcome to the Financial Fitness Podcast. I'm Rich Rosso here with the Jonathan McCarty.
Good morning, Rich.
How are you, sir?
Doing well. Good to be back.
It's not nice to lie, really. Not nice.
Yeah, I was telling Brent, I'm pretty sure my gravitational pull expanded a bit over the holiday break.
The earth is just a little heavier.
That's right.
Holidays went fast.
They did.
They did. But they were absolutely fun. So we're into 2026. I'm sort of disappointed it isn't over yet. And we have the one big, beautiful bill. OBBB, as we call it. I heard someone pronounce it. Someone the other day, seriously, like on one of the stations. Yeah, the OBBB. And I'm like, is this guy having a seizure?
Stroke. Conveniently, also my son's first word.
Yeah, OBBB. Jonathan's baby's got real dark hair, but he'll be wearing that blonde wig going, OBBB. You know how many views you get on Instagram with that?
Oh, yeah. Yeah. Insta famous.
Oh, you'd be like,
my wife is
digital
anti-social
creator
media
of the year.
for the
You
kid.
know what? I like her more.
Yeah. Yep.
Is she anti-chat room?
She is.
Oh,
yes.
oh,
yeah.
I just love
She
her.
actually does like to read some of the chats sometimes on the show. She'll watch it occasionally and reread the chats, and she gets good laughs out of that. So thanks, guys.
Can't be Larry. I think Ice took Larry off. I think he's gone, isn't he? I don't see him on the chat.
Do we have to restrict
He
him?
finally got him. They finally got him. So listen, this 2026 tax season, if you ever needed a tax specialist or a really good financial specialist or partner, this is the time. There are lots of deductions. So we're going to talk about the big D, and I don't mean Dallas. It's deductions today. It's higher, retirees, near retirees, late career workers, but listen, just standard deductions overall. So we're going to break it down. And before we do this, bigger picture, there's a lot of good stuff in this bill, I think, Jonathan. I understand the phase outs, and I understand they're till 2028, and I understand how people gripe. But there's a part of this that really hits the working class, which I really like.
Absolutely.
But I also fear that many people will miss some of these deductions because there are many of them.
Yeah.
Overall.
Hard to keep track.
Yeah, it's hard to keep track. But these changes are going to impact your tax planning strategy. So we've got just a broad overview. We have higher standard deductions. We have new age-based write-offs for SALT limits, auto loan interest deductions, larger 401k catch-up contributions, deductions for tipped workers, overtime pay. So we're going to go through that with you. And it's a good month for you to gather your tax data and figure out which one of these is going to work for you.
That's right.
I think one of the most important ones is the one big beautiful bill, higher standard deduction. Most taxpayers are going to select the standard deduction, right?
Yep.
That's just the way it is. So the OBBB added an extra 5% increase to the inflation-adjusted standard deduction for the 2025 tax year. So you're married, filing jointly, or a surviving spouse, your 2025, your deduction actually is $31,500. So that's a pretty big hurdle if you're going to itemize. And keep in mind, if you're 65 and older, you get a bigger standard deduction. That's an extra $2,000 for single filers. Has a household, $1,600 more for qualifying spouse or joint return for a total of $3,200. And it's double for those who are age 65 plus and blind to $4,000 for an individual and $3,200 for a qualifying spouse. So that That's just the overall standard deduction.
Yeah, and that's a big help for a lot of individuals. Even if you have a mortgage, obviously mortgage interest being one of the biggest itemized deductions for a lot of individuals if you don't own a business, right? That's hard to overcome, that $31,500.
It really is.
Yeah.
It really is. Now, what I don't like is when you hear people in the administration saying, listen, there's no tax on Social Security. There is.
Yeah.
Right? We're just, money's fungible, so we're moving things around. So if you're 65 or older at the end of 2025, there's a new federal income tax deduction up to $6,000 if you file an individual return, $12,000 if your spouse is also 65 or older and you file jointly, right? So this is sort of the Band-Aid for taxation on Social Security. So that's new, and you don't want to miss that.
Well,
right?
And if it's a little bit of wordplay by the administration,
Exactly, right.
but if you consider that most retirees, unfortunately, are only living off of Social Security, now with the higher standard deduction and the additional $6,000 per person, effectively there are very little, if not any, taxes on Social Security at this point.
Exactly, and that's good.
Right.
That's good for a lot of seniors who, for the most part, live off Social Security.
Right.
Now, there is a modified adjustment gross income phase out, but it's $150,000.
Yeah.
So a lot of these seniors are not going to hit anywhere near that, right?
And if you're hitting $150,000 in retimement income, I think you're pretty comfortable at this point.
Yeah. So for the most part, you're a senior, you're living on Social Security, or that's your primary guaranteed income. This, along with the standard deduction plus this additional deduction, is really a nice boom, and you may not realize you're going to get it. One thing we haven't talked about, it's not a deduction, but people also realize when this bill came to pass in July of last year, a lot of people didn't adjust their withholding. So you're based on the tax foundation, you're going to see an extra $300 to $1,000. Now, it's the return of your own money. I get that. But what I'm saying is you may not realize if you hadn't adjusted your withholding that you might get a bigger refund.
Yeah. So it's going to be a nice surprise for a lot of individuals who kind of didn't take that proactive approach and make the adjustments once the bill passed.
I'm not a big fan of withholding. I'm not a big fan of getting my money back, my own money back.
I'm not a fan of interest-free loans to the government either, Rich. I definitely am with you there.
Yeah. But, there are people that are just not as maybe financially disciplined, so they look at it as a windfall, but it's really just, return of your own money. But for some people, that's, I hate to say it, but that's sort of their budgeting technique.
Yeah, and a lot of people consider that kind of their end-of-year bonus.
Exactly. Only in America will you consider an end-of-year bonus as the return of your own money. It's like, go ahead, kick me.
Yeah.
Let me kick myself.
Is that barrel I'm bent over? Oh, perfect. Yes, I was looking for that.
So, there's an example here. The AARP has an example. You're 70 years old and single. If your modified adjusted gross income is $80,000, $5,000 over the $75,000 threshold, your deduction is reduced by $300. So even the reductions are not that bad. But to Jonathan's point, if you're making $150,000 in retirement, you're not concerned about it. But to me, this is most important to hit what you want, the people that you want to help.
Who need it most, especially
Exactly.
in this inflationary environment. They're really feeling the pinch.
So the message here is you have a more robust standard deduction. And if you're 65 plus, you have a bonus standard deduction. Also, Brent will come to your house and hand you a gift from the Publishers Clearinghouse. It'll be a fake check.
That's about all those checks are good for anymore.
I don't even see them advertised anymore.
Oh, they went bankrupt.
Oh, did they?
Yeah, I believe they did. Yeah, so all those people that took those lifetime payouts, they're not getting them anymore. If I'm not mistaken, I'm pretty sure PCH went bankrupt. I remember reading that a couple years ago.
Must have been the cost of those big checks.
Yeah. Time value of money, guys.
Damn. That's when, the Columbia House records. We're going to talk about something Jonathan doesn't remember, but, get 10 records for a penny.
Well, there's those things called vinyl, I think it was. Yeah.
Well, even cassettes. They went to 8-tracks and cassettes. And then you would order them, and they would chase you down for the money because you'd had to order something else after that. Like, you're committed to, paying, double for a cassette. Like, in other words, you're paying for those 10 for a penny.
Yeah.
Because if a cassette's $8.99, you're paying $25.99 for the cassette. I'm like, I'm not buying. Go ahead and find me. Go ahead. Team up with the Publishers Clearinghouse. Call ICE. You can't find me.
They should enlist not UNICEF. Oh man,
USAID.
There we go. Yeah, those people will find you anywhere, and they are relentless. Yeah.
Oh, we're having fun this morning. So what is different? Now we have this higher SALT deduction. So if you do itemize, you can deduct certain state and local taxes you paid during the year, or sales taxes, real estate taxes, qualified personal property taxes. So this SALT, this was a big area of contention. This was an issue.
Yeah.
Remember?
Yeah.
When they were going through this whole process of the big, beautiful bill.
Yeah.
And from 2018 to 2024, it was $10,000. Now it's $40,000 for single filers and married couples filing jointly. So state and local tax, we don't have it in Texas, but some people obviously do.
Yep.
Could make the itemizing, even though we have a better standard deduction. For some higher income people, it might work. So now it is going to have a phase out, but this one is sort of nebulous, right? Because it's $40,000 cap is reduced by 30 cents for every dollar of modified adjusted gross income over $500,000 if you're married filing jointly.
Now, is this deduction in addition to the standard?
No.
Or do you have to itemize to get it?
Itemize to get this.
Good-
So some
good
people will have
clarification.
to make the choice.
Yeah.
So I talked to a client yesterday, and he's also very big on the charitable side. So we decided, okay, he's going to itemize. It's going to be interesting to see the numbers. And mostly it's going to be the coastal states. You know, they're going to be the benefits Northeast. They'll benefit more from this SALT deduction. But, for some people, it's going to be... You have to have a tax specialist crunch the numbers to see which way to go.
Well, especially for those states that have the personal property tax, taxes on your vehicles, on your extra, boat, if you're a boat kind of person, or airplanes, whatever those hobbies may be for you in retirement. That's really where it's going to have benefit for people on the East Coast, West Coast.
Yes. So now here's an interesting one. There's a new deduction for car loan interest. So if you took out a loan in 2025 to buy a new, not used, it's got to be a new car, minivan, SUV, pickup truck, motorcycle, you could deduct up to $10,000 of interest paid during the year. So here's the thing. The vehicle's final assembly must have taken place in the United States.
I really love that
must
aspect.
weigh less than 14,000 pounds, even when your mother-in-law is in the passenger seat. So that's, there are certain restrictions to this. Now, the National Highway Traffic Safety Administration has a VIN decoder. Now, I will tell you, you won't even have to worry about it, because these dealerships who are out there that are able to promote this,
They'll tell you.
yeah,
Yeah.
you're going to know. This is assembled here. It fits the deduction. Now, once your modified adjusted income surpasses $100,000, if you're filing single, $200,000 for joint, the deduction is reduced by $200 for every $1,000 over the threshold. Okay. If your modified adjusted gross income is $150,000 single, $250,000 more as joint, you're not going to get it. And what's cool about this, if people are 65 and older, you can claim this car loan interest deduction whether or not you itemize.
Yeah, that is a nice schedule.
Now, again, a lot of this stuff phases out in 2028. Keep that in mind. New administrations, all this changes. There's really nothing that's permanent, but you can use this for now. So I have some people that have been talking about, well, I'm going to take advantage of this.
Yeah, well, especially considering new car prices now for a higher end car, you're looking at $80,000 north of $100,000, even for something like a pickup truck.
Absolutely, yeah, it's absolutely out of control. What are loans now, like 180 years?
Yeah.
Your
Pass them on to your
grandchildren, your
children.
great grandchildren can assume the loan. Is that how far out we go?
Yep.
I think we're something like 80 months, 70 months.
I haven't
I think
financed a
they've
vehicle
been
in a while,
extended
but
out.
yeah,
72 months.
Yep. I wouldn't be surprised if they have 84. Book them in for life,
See how
guys.
many people die before they reach the end of the car payment.
Or the useful life of the vehicle. You know, depends on how much you drive.
Yeah, it is a little out of control. I think this deduction should have been bigger. I understand assembled in the United States and all that.
Yep.
But I do think that where there is that much inflation when it comes to car prices, I would have made this a little more generous.
Yep.
But I think it's great. So now you have larger catch-up contributions, say if you're age 60 to 63. And again, we got this little window. For 2025, the basic contribution limit was $23,500. Workers 50 and older add another $7,500. A catch-up contribution for a maximum of $31,000. But you have this 60 to 63 at the end of the year. You can make an even bigger catch-up contribution up to $11,250. So that's a total of $34,750. And that was part of the Secure Act.
Yeah.
So we only have this little window. Now, I will tell you, there are some people that are going to be jumping on this because they're super savers. And they're like, man, accelerated catch-up. I'm in the window. You also have to keep in mind your employer has to be willing to, the benefits, that you're working through. They may or may not have this in place.
Right.
So you think you're going to get it, but you may not. So if you are a super saver and you want to do this additional catch-up, it's really a good idea to talk to your benefits department and figure out whether or not this is going to work for you.
I think one of the big benefits of this year is that now, catch-up contributions head into the Roth 401k. Unfortunately, a lot of those companies didn't have that set up for last year, so all of these extra bonuses you could put in can't go into that Roth if your company didn't already have it set up.
Well, they're going to have the Roth this year because one of the things you're going to see is you're still working. Your income, your wage income, W-2 income, is over $150,000 or more. Your catch-ups are going to Roth.
Correct.
You have no choice. Actually, I think that's a good thing.
I do, yeah.
I think the government, again, is very short-term in its sights because they need the government now. We need the money now, right? We call it the J.G. Wentworth effect. But I think, if I'm not mistaken, what the federal agency, what the IRS was saying, listen, if you all don't have this set up at your company, you're not going to have catch-up contributions at all.
Really?
Yeah. I mean, they were truly pushing, because this whole Roth provision should have been done
Years ago.
Yeah. So keep that in mind that why do I have Roth? Why do I have Roth money? Don't complain about it. Your catch-up's going to go to Roth. Now, I haven't seen anything about this, but also your matching contribution was slated to also be placed into Roth. So when you contribute to your pre-tax retirement account and you get an employer, even if, say, it's 100% Roth, you listen to us, you listen to Jonathan, and you know that you need to diversify your accounts and have some Roth money. Your catch-up contributions, generally speaking, would be in your pre-tax account. It would get siphoned off there. But there is legislation out there to say, no, you have a choice. But I also think that goes back to your benefits department. These are questions you need to ask. Can I have my catch-up contributions based on the Secure Act moved into Roth? Anything you can do to move money into Roth is a good idea. Because listen, this OBBB is temporary. All this stuff sunsets in 2028.
Yeah.
You get a new administration and we know where taxes are going, right?
Yep.
I'm still a believer that taxes inevitably are going up.
As am I.
Yeah. But you're getting this break within these years to take advantage of this. So now you are a tipped worker, and you receive tips for performing the job, and this is now, again, you got to look at what's a qualifying job. And we're going to talk a little bit about the new deduction for tipped workers. So the Treasury Department website, they go through the full list of qualifying jobs, okay? If you have, now, again, I don't understand why certain parties are upset or say, oh, this sucks, this is no good. I think this is pretty good. I understand it sunsets, but that would be any administration, Democrat or Republican, okay? But if you're able to deduct up to $25,000 of cash tips you've received in 2025. Now, if your modified adjusted gross income exceeds $300,000 for joint filers, it drops by $100 for every $1,000 of modified adjusted gross income over the threshold. And once you hit $550,000 on a joint return, it's gone. But then who needs it? But what I'm saying is, you're a bartender, you're a waiter, you're a hairdresser, you're a hotel maid, or whatever it is. I think this is a great benefit.
It is, yeah. And if you notice on that list, it's really focused on more blue collar workers. And so, my mother works part time still. It's just a side hobby. She's a concierge nurse. So she goes on site and provides IV services, things like that. She was a nurse for 30 years, and now she does this a couple days a week just to give her something to do out of the house. But she also receives tips as part of this business. And she was very excited about this no tax on tips situation. And after looking into it, I had to explain to her, unfortunately, you don't qualify for this, Mom, because she is not in one of those categories. They geared it more towards, like many of the other aspects of the OBBB, it's geared more towards lower income, blue collar workers that really stand to benefit significantly from this tax avoidance.
So, Mom's not going to work at Denny's.
Nope. She did the waitress thing in her youth, and it gives her an appreciation for people who still work in that industry. And I myself used to wait tables, so I have an appreciation for that as well. But unfortunately, no, she does not qualify because it's more of a skilled profession that she's still working in, even though she does receive tips.
And they did close down the Playboy Club.
Yep.
So she can't work there.
I'm out of work there as well. Yep.
You did.
Hey, I lived in Los Angeles. You have to do what you have to do to get through college. Come on.
I'm sorry. I'm so sorry for you. You still get you have any kind of like PTSD from living in LA? Or?
No, it's a different acronym, but they make a pill for that. So, yeah.
It's only gotten worse since you've left.
Yeah.
JP goes, Rosso, what would Grandma say about the OBBB? Add garlic to it. Anytime you add garlic, it works. Mm-hmm. So the key here, this is going to be more of a shorter, we'll talk about a few other things here when it comes to taxes. Just the tax prep. But there are a lot of good things in the bill that even if you can't participate, could be your children, your in-laws, whoever it is, and you want to work with a, I'm sorry, Java Joe goes, I bet Larry is in Minnesota opening Python daycare centers. Oh, it's pretty funny. The Leering Center, not the Learning Center. It's the Leering Center. Python Refugee Center.
Killing it, guys.
I'll tell you, I'm giddy this time of the morning, and the chat's really going to set me off here. Enough to where we may not have a podcast anymore. So there is just a lot of ways to carve it out. I think for most, especially if you're charitably inclined, the bigger decision for many is going to be itemizing or not because of SALT, right? And where you are from the perspective of standard deduction. I still think the majority of Americans are still going to be with all the standard deductions, especially if you're 65 plus. That is still going to most likely be the standard, so to speak, overall. So let's wrap this up with some ideas as far as it's not too early to start sort of getting your tax bearing from a paper perspective, making sure you've got everything lined up. What do you think?
Yeah, I think it's important to prepare ahead of time. You don't want to be that person running to try and get their taxes done on April 10th, April 14th. Although I will admit in my youth, I was that guy on more than one occasion. Mm. But thankfully, my wife is in charge of that now, and she will have all of our documents ready to go by the end of this month, I imagine.
A couple of years when I first started, I forgot to file. And I get a letter.
Ouch.
Oh yeah, that.
Well, the other thing to consider
I was
as
just never a big fan of paying taxes. I don't not pay them, but I'm not a big fan.
I'm not signing up to write that check to Uncle Sam.
No, it's not like I'm going, oh my God, this is my patriotic duty. Yeah. I used to say that before the Leering Centers came along, but now I leer. I just leer. at the check.
It's like the homework assignment of the year.
It is.
Yep.
Yeah.
My dog eats mine.
My
a
dog
lot.
ate it, yeah.
Check. But, another good thing to do this time of year, if you are collecting those documents, is think about things you didn't complete last year, like IRA contributions. Right?
Yes.
If you're looking to kind of move the dial one way or another, if you're close to one of those phase-out thresholds, and you can make a deductible contribution, or you can make any type of adjustment in the last, Hail Mary 11th hour to get you under there and take advantage of some of these programs, now's the time to start thinking about that.
Absolutely. I think, again, now I understand. Now, if you go to the taxfoundation.org, they have examples of people who benefit the most from these overall marginal rates. Obviously, the marginal rates, 20 and 24% marginal brackets are a lot bigger. So for purposes of your Roth conversions, you still have time to make some sizable ones, depending on when you crunch the numbers. Your financial advisor crunches those numbers. But you have to keep in mind that it's still important to look at this from a Roth, even though you have all these Roth options, which I think is great. You want to take advantage of this Roth, because this Secure Act was the Rothification of America.
Yeah, it was. Yeah.
It was the government needs money now. Now, I don't know, in 40, 50 years, maybe they go, wait a minute, what the heck did we do here? Right?
Well,
and we start taxing distributions. I don't know. But for now, the fatted calf is in pre-tax accounts. That's what you're trying to tackle. Why is there so much leakage? Why can you take out money out of your retirement accounts for pretty much anything?
Yeah, and you make a good point, Rich, that we don't know what's going to change in the future, and that's actually a question I get somewhat regularly from clients, is, well, we're making these Roth contributions, and they're supposed to be tax-free, but how do we know that's going to happen? And yeah, the possibility does exist that they change tax law, but like we've seen in previous tax law adjustments, it's typically a grandfathered-in scenario. So, and that's kind of what I tell clients. If they do make these changes, the contributions that were already made and have been taxed hopefully will remain so.
Yes.
And they may make changes to future contributions, and there will be some stipulations there that will be probably more complicated than we'd care to speculate here on the show. But, take advantage of the environment that we're in now. Don't try and focus on what may come. Let's look at what we can operate in today.
Because for the most part, for generations, the pre-tax bucket is much more appetizing to look at.
Right.
There's much more there to fight with and much more tax dollars to grab. So the Roth is not going to be the focus. Now, what I think if there's an issue with Roth is, and how many people use Roth for legacy purposes.
Yes.
So in case you didn't realize, if you have non-spouse beneficiaries on your pre-tax accounts, retirement accounts, and you, again, put your children, they used to be able to take that money out over their life expectancy. Now, generally speaking, there are some caveats to that. It's 10 years.
Right.
So some parents will say, listen, I've got kids that are professionals and so forth. I'm going to bear the tax burden here, do the Roth conversion, and have them take that money out tax-free. They still have to take it out over 10 years, but I do the 1 in 10 or the minimum in 10.
Yeah.
And what I mean by that is I have to have that money sitting in that Roth for I don't want to touch that money.
Right.
I have to manage that differently, right? If I have clients that have, and you may too, Jonathan, they have IRAs from their parents and their pre-tax. We sort of have to play a little bit of a tax game.
We do.
We have to take out their required minimum distributions, but then we have to decide, do we take more? Because we don't want this end of 10-year tax time bomb when all this money has to come out and be taxed. So we are going to maybe draw out some years, depending on the income of the children. We're going to take out more than the required minimum distribution. With one child, for example, we took more out this year because next year they're going to be in a higher bracket, right?
Yep.
So it's a little bit more of a challenge than when you have that money in Roth, don't you think?
It is, and so that's really the premise behind employing that strategy while you're still alive before you pass these assets on to your children, because you're probably in a lower tax bracket than your professional, educated, and employed children, and that's only going to get worse as things move forward. As we talked about, we do expect the tax rates to increase over the long term. So
Yes.
if you're looking at this
Right.
as somebody who's just retired, you're 65, 67, and you've got children who are in their early to late 20s who are already working in a professional industry and are earning a higher income than you currently have, it already stands to benefit them that you take those distributions or those conversions, pay the taxes at your lower rate, and then start squirreling that away for planned passing on to your children. If you wait until the end, to your point, Rich, I mean, this is going to be distributed at their marginal tax bracket.
That's
I mean,
right.
That is the highest tax bracket they're in, and it could easily push them into the next one.
Unless your kid's just living in the basement and doesn't have any tax bracket. So
Probably on the internet all day.
P.S.
Has a neck beard.
They should let you deduct interest on your car for people who live in their car. Well, I think you get a homestead exemption. I'm kidding. Absolutely kidding on that.
New definition of snowbird.
So there's a lot to take advantage of. And by the way, if you haven't signed up for our 2026 Economic Summit, I personally am very excited to have Ed Slott there. So Ed Slott is the advisor's CPA. I've been using Ed probably as a resource. How long I'm going to date myself here? 23 years, 24 years. And he's one of the best. He understands what we try to do with Roth conversion strategies, but he is one of the best when it comes to strategies for clients. He is going to be there, along with Adam Taggart, who's always very happy and upbeat and a absolute bull on the market.
It's the avocado toast.
Brian Dunlap. We've got, Lance and Michael. Daniel King. This is about crypto, artificial intelligence. Like, this is a class. And we're going to feed you. Okay? So it's the Royal Sonesta, January 17th, 7 a.m. to 4 p.m. Oh, my goodness, 7 a.m. to 4 p.m.
With some breaks for food.
Well, yeah, it's a long day. $199.99. That was a mouthful.
It was.
Yeah. I think for what you're going to get, it's a bargain. And by the way, people think that we make money on this. We don't really. We have to pay everybody. We actually put money out of pocket for this event. Okay? This is not like, oh, look at RIA bringing in all the money. It's just like, what is it? The Flying Saucer Pie Company?
Yeah.
In Houston, there's this iconic pie company. And they're saying, listen, guys, business is slow. We're on holiday time. Can you buy some pies? And you should have seen the comments on this.
Really?
These people make millions of dollars selling pies. I'm like, do you understand what you're saying?
Completely detached from reality. Yeah.
What exactly is a margin on a pie?
Yeah. The crust.
Thin crust.
The crust, yeah.
Yeah. I mean, it's absolutely ridiculous. So, keep in mind that, let's say we got a question. Can I still make Roth conversions and have it count for 2025? No.
Oh.
Sorry.
Yeah.
That ended on December 31st.
Calendar year specific.
Calendar year specific. Yeah. Now, different when you're going to contribute to a Roth IRA, right? You have up until your tax filing deadline. But no, as Grandma Rosso would say, no, you cannot do that. And if I'm around, you're going to get a beating. So 12/31 was it. But again, you have the OBBB that's going to be around for a long time. Relatively speaking, if you're going to be aggressive with Roth conversions, 2026 still a good year unless you have some income restrictions. Maybe your Roth conversion has to be less. But for the most part,
Now's
you
the
have
time.
some. This is the time
Yep.
to do them.
Yep.
The last thing I'll say is this. When Danny and I started talking about Roth about 8 years ago, about really pushing it and why it was important and why diversification about is important, we have people coming out of the woodwork that want Roth now, but they may not be right for Roth.
Right.
You've got to crunch the numbers, especially people who do not have a legacy intent. They don't have children. It's very tough for me to say, do this Roth conversion. Unless it's really going to save you a substantial amount of taxes, I don't know if it's worth it.
Well, so the one consideration that I tell for clients, we talk a lot around long-term care costs. And if you're one of those individuals who does not have children, then you need to be thinking seriously about what that's going to look like at the end of your life. Mm-hmm. And that is one impact that would be in favor of Roth conversions even earlier on in life.
Because I have these big dollars
That's right.
that would have to come out.
That's right. And so if you're taking, $400,000, $500,000 a year out of your pre-tax IRAs to cover long-term care expenses, a significant portion of that is going to taxes. So
And IRMA.
And IRMA,
Right? All
exactly.
the backdoor taxes.
Although
right?
if you're in long-term care situation, IRMA probably not
Yeah,
too much of a
that probably is
concern
true.
for you with that look back.
That's true.
You'd be lucky to make it those extra 2 years. But that is a serious consideration. If you're looking at how much am I going to need for healthcare costs at the final stages of my life, if you're taking off 25 to 30% of that, if you're taking out massive distributions from your IRAs, that's going to impact the ability to fund your own care. So something to consider if that's the situation you're in.
So Mr. Clanton does a poll. Which 2026 tax change matters most to you? Higher standard deduction and new 65 plus tax deduction win. Larger 401k catch-up contributions, distant third. So the deductions are hot. Hot.
It's on everyone's mind.
They're on everybody's mind. Not anything on the SALT deduction because we have a lot of people that wouldn't be able to take advantage of that.
Correct.
Right.
Yeah.
And mom-in-law can't take advantage of the no tax on tips.
Nope.
So she's all set there. I'm interested to see what the average tax refund looks like this year.
Yep. Well, they have projected it will be higher on average.
Right.
So let's see by how much. But one thing that Rich, you didn't mention about the Economic Summit next weekend is they'll also have the privilege of meeting Rich Rosso, possibly also Grandma Rosso. Our whole team is going to be out there.
Well, yeah, I plan to do a whole Tony Perkins psycho thing. I'll have a gray wig in my pocket and then turn around as grandma. So I'm planning on doing that.
We know you carry that wig around.
I don't think I have the right size dress and pillows to represent my poor Nana, who is built like a fire hydrant. But I do, probably can get that gray wig.
Yeah.
But I got to pinch your cheeks then, and you a nicer, chunky boy. So we won't do that. Do you guys ever think about having pension funds, in Switzerland? We have James Bond here on the chat. Informed and legal. I don't know. We've never really explored the whole Switzerland connection. But I will tell you this. If we buy Greenland, I'm moving. All right, I'm out of here. There's only 30,000 people there. And it's ice and snow most of the time. Nobody sees each other. Yeah. I'm there.
Yep.
Okay, I am out of here. I am there.
Get off my lawn.
Get off my frozen lawn.
Get off my tundra.
Yeah.
There you go. Good
out.
question here from the chat. Is there a shuttle from the airport to the hotel? I do not believe that there is. No. So
Well, are you staying at the? If you're
coming
staying
from
at
out
the
of
Royal
town,
Sonesta,
I don't believe there's a hotel shuttle from IAH to the Hotel Sonesta.
no.
No, there's not.
I don't know if the hotel operates a shuttle.
Yeah,
that's,
correct.
That's
now
the
that's a
question.
good
Yeah.
question.
Yeah.
I'm not sure of that.
We'll look into that
We'll
for
have
you,
to look
Blair.
into that for you. It's a good question. I was thinking that if you needed do you need us to carry you down from the 10th floor? Jonathan is trying to work out more. He can come and grab you.
My New Year's resolution,
Yeah.
as always.
Yeah.
Well, we could give him Rosso's cell number and just go pick him up at the airport.
Yeah.
I mean,
that'll work.
We are a full service operation.
Yeah,
there.
And then when it'll happen is when you call me, it goes right to Brent.
Call forwarding.
Call forwarding.
Wait a minute. I'm on the bottom of that totem pole, guys. I don't like this idea.
I got seniority.
Yeah.
But I will tell you, when we did the summit last year, Lance and Michael's presentations to me were CE level. I would have given that presentation to any advisor, any investor. Of course, those two, one bonds and the markets in general, were absolutely astounding.
Yeah.
We decided that we wanted to sort of diversify speakers and bring in also things because of the OBBB. And although I'm sorry, Ed Slott will slap me if he hears me call it an OBBB. So I'll have to be careful around him. And crypto and AI, which obviously is the buzzword, the buzz letters, which we will be around for, every time I think of Ricky Ricardo, that's going to be me. So imagine Rosso as your Uber driver. I'm going to tell you something. I am terrible with directions. I grew up in New York, and all I had to do was get on the trains. So, we would never make it to the Royal Sonesta.
Yeah.
It's not going to happen. So some people are born and I admire them with a sense of direction. When I was 5 years old and we're driving up to, my dad had a 1970-something triple black Cadillac convertible, and you don't strap yourself in the back. You just go.
Nope. Enjoy the slides.
You just slide across, right? And I said, so I remember at 5 years old, I would lean over and go, Dad, how do you know where you're going? He goes, oh, you'll get there. Never did, Dad. Never did. So no, you don't want me. So that's pretty much all we have. But again, work with your financial advisor. Work with your tax specialist to make sure you are taking advantage of these new deductions, new catch-up contributions. Make sure your family understands that, what's out there. We have a lot of people that work gig jobs as waiters, kids, younger adults that are doing that, and they may not realize that they have this available. That's all we got for today. Thanks for joining us. We appreciate you.
Have a good weekend.